It starts with a sound, a sharp digital beep that you have heard 1,000 times before. But this time, the tone feels different. You are standing in the checkout line at the grocery store, the fluorescent lights humming above you, a cart full of essentials for the week ahead sitting on the belt. Behind you, the line is growing, people shifting their weight, checking their watches, impatient to get home. The cashier looks at you, then at the machine, and says the words that instantly make your stomach drop. Transaction declined. You force a smile, you apologize. You tell her to run it again, mumbling something about a chip error or a glitch in the system, because you know you just paid the bill last week. You know you have a $10,000 limit. You know your balance is only $4,000. You should have $6,000 of safety net sitting there, waiting for this exact moment. She runs it again. Beep. Declined. You pull out your phone, your hands trembling slightly, trying to unlock the screen before the stares of the people behind you burn a hole in your back. You open your banking app, waiting for the little circle to spin, praying that it's just a mistake. But when the numbers load, the reality hits you harder than a physical blow. Your balance is still $4,000, but your available credit is zero. Without a phone call, without a letter in the mail, without a single notification or warning, the bank has quietly, secretly slashed your limit from $10,000 down to exactly what you owe. They have choked off your lifeline. This is not a glitch. This is not a system error. And this is a silent cut. And right now, as we speak, this silent suffocation is happening to millions of people across Canada and the United States. A coordinated withdrawal of liquidity that signals something far more terrifying than just a bad day at the grocery store. Welcome back to the channel. Today, we are not talking about the housing market crash or the inflation numbers that the government feeds you on the nightly news. We are talking about the invisible crisis that is happening inside your wallet right now. We are talking about the Great Credit Freeze of 2026. While the media distracts you with political theater and international skirmishes, the banks are quietly building a wall around their capital. They are revoking your access to liquidity. They are closing the exits. If you think your line of credit, your credit cards, or your home equity line of credit are your money, you are about to learn a very painful lesson. The banks are scared. And when banks get scared, the first thing they do is make sure you cannot borrow your way out of the coming storm. To understand the magnitude of this betrayal, you have to peel back the layers of the relationship between you and your bank. For decades, these institutions have pushed credit on us like a drug dealer pushing product. They bombarded your mailbox with pre-approved offers. They called you during dinner to increase your limit. They ran commercials telling you to tap into your home equity to renovate your kitchen or take that dream vacation. They wanted you in debt. They wanted you servicing that debt. The entire modern economy is built on the velocity of this credit, or on the assumption that you can spend money you haven't earned yet. But the tide has turned. The economic waters are receding, and the banks are suddenly desperate to reduce their exposure to you. What makes the silent cut so insidious is the total lack of warning. In the past, if a bank took adverse action against you, they sent a formal letter. They gave you 30 days notice. They explained why. Today, the algorithms move faster than the mail. Banks are using advanced risk trigger algorithms, artificial intelligence systems that monitor your spending behavior in real time. They are looking for signs of distress that even you might not realize you are showing. Did you start shopping at a discount grocery store instead of the premium organic market? The algorithm sees that as a sign of financial weakness. Did you make a minimum payment instead of paying the full balance for the first time in 2 years? That is a red flag. Did you take a cash advance to cover a bill? That is a siren blaring in the bank's risk department. When these triggers are tripped, the computer makes a decision instantly to cut the exposure. If you have a $20,000 limit and you only use $5,000, the bank looks at that empty $15,000 space not as available credit for you, but as a liability for them. If you lose your job tomorrow, you might run up that $15,000 and then default. So, to protect themselves, they delete it. They lower your limit to match your balance. They call it risk management. I call it financial suffocation, because when they cut your limit, your credit utilization ratio skyrockets. You go from using 20% of your credit to using 100% of your credit overnight, even though you didn't spend a penny more. This crashes your credit score. And when your credit score crashes, other banks see it, and then they cut your limits too. It is a death spiral, a self-fulfilling prophecy of financial ruin engineered by the very institutions you trusted with your livelihood. You might be asking yourself why this is happening now. You have been a loyal customer for 20 years. You have never missed a payment. Why are they treating you like a criminal? The answer has nothing to do with you. It has everything to do with them. The Canadian and American banking systems are currently sitting on a ticking time bomb of bad debt. But the bad debt isn't necessarily yours. It is theirs. The commercial real estate sector is collapsing. Office towers in downtown Toronto, Vancouver, New York, and Chicago are sitting empty. The loans on these buildings are in the hundreds of billions of dollars, and they are going bad. The developers are defaulting. The property values have plummeted. The banks are staring at a massive hole in their balance sheets. They are technically insolvent in many areas if they were forced to mark those assets to market value today. When a bank loses billions on bad commercial loans, they have to hoard cash. They have to increase their capital reserves to survive the regulators. Every dollar of credit limit they extend to you requires them to hold a fraction of capital in reserve. By slashing your credit limit by $10,000, they free up capital on their books to cover the losses they are taking on their bad bets in the stock market and real estate sector. You are paying for their mistakes. They are freezing your ability to buy groceries or pay for emergency car repairs so that they can remain solvent while their commercial real estate portfolio burns to the ground. This is a credit crunch in its purest form. It is not announced on the news. There is no press conference. It is a silent constriction. It is the financial equivalent of the oxygen being slowly sucked out of the room. You don't notice it until you try to take a deep breath and you realize you can't. If the credit card cuts are the jab, the home equity line of credit freeze is the knockout punch. For the last decade, Canadians have used their homes as ATMs. And the wealth effect was built on the idea that as your house price went up, you could borrow against it to buy a car, go on vacation, or renovate the kitchen. Unlock the equity in your home, the commercial said. But here is the fine print that nobody reads. HELOCs are callable loans. This means the bank can demand full repayment at any time, for any reason, without notice. Most people treat a HELOC like a mortgage, a long-term debt that they can pay off over 25 years. But it is not. It is a demand loan. As property values in Toronto and Vancouver begin to slide, as the appraisal cliff becomes a reality, the collateral backing these loans is shrinking. If you have a $500,000 line of credit on a house that was worth $1.5 million, and that house drops to $1 million, the bank gets nervous. We are already seeing reports of major Canadian banks sending letters to homeowners stating that due to a reassessment of property values in their area, their credit limit has been reduced. Or worse, that their access to funds has been frozen entirely. Imagine you are a small business owner using your home equity line to pay payroll during a slow month. Suddenly, the account is locked. Checks start bouncing. Your employees don't get paid. Your business collapses in a week. Not because you didn't have the money, but because the bank decided they didn't want to lend it to you anymore. This is the ultimate rug pull. They encouraged you to build your life on this debt foundation, and now, just as the economic earthquake starts, they are pulling the foundation away. This is central to the you will own nothing agenda. If you cannot access the equity in your home, do you really own it? Or are you just a caretaker for the bank until they decide to foreclose? The victims of this silent cut are not just individuals. The biggest casualties are small businesses. Small businesses are the backbone of the Canadian economy, but they are considered high risk by banking algorithms. Most small business owners rely on revolving credit, lines of credit, and business credit cards to manage cash flow. They buy inventory on credit, sell it, and pay the bank back. It is a cycle. Right now, banks are aggressively cutting lines of credit to the construction, retail, and hospitality sectors. I spoke to a contractor in Mississauga just last week. He had a $50,000 line of credit he used to buy materials for jobs. Now he went to the supply store to buy lumber for a renovation. Card declined. He called the bank. They told him that because the construction sector is deemed volatile right now, they conducted a review and eliminated his line of credit. He couldn't buy materials, he couldn't start the job, he lost the contract, he had to lay off his 3 guys. This is how a recession becomes a depression. It is not that there is no work, it is that the mechanism of payment has been broken. When banks stop lending, the velocity of money stops. This is a deliberate strangulation of the independent economy. And who wins? The big corporations. The massive conglomerates that have direct access to bond markets and don't need a local bank line of credit. The silent cut is clearing the playing field of small competitors and leaving the market wide open for the corporate giants to consolidate even more power. There is a psychological element to this that we must acknowledge. Living with a slashed credit limit changes you. It creates a constant, low-level hum of anxiety. You stop spending, you hoard cash, you become afraid to use your card for fear of a decline. This is exactly what the central planners fear, a deflationary spiral. But it is also what the banks are forcing to happen. By cutting your limit, they are telling you that you are not safe. They are stripping away your financial autonomy. And this leads us to the darker purpose. The silent cut is a training ground. It is a conditioning program. We are moving toward a world where access to money is a privilege, not a right. Today, they cut your credit limit because of risk management. Tomorrow, will they cut your access to your digital currency because of your carbon footprint, or your political donations, or your social media posts? The technology is exactly the same. The algorithm that decides to cut your Visa limit today is the grandfather of the algorithm that will control your central bank digital currency wallet tomorrow. They are testing the brakes. They are seeing how much liquidity they can pull out of the system before the population riots. And so far, the population is doing nothing. We are just embarrassed. We are hiding our declined cards and suffering in silence. This credit freeze is pushing people into a corner. When you can't borrow, you have to use cash. But wait, they are trying to ban that too. Notice how hard it is to withdraw large amounts of cash from a bank branch lately? Try asking for $5,000 in cash. They look at you like you are a drug dealer. They ask you what it is for. They tell you they have to order it in. Why? Because they don't have the money. The fractional reserve banking system means they only keep a tiny fraction of your deposits on hand. If everyone went to the bank today to withdraw their money, the doors would be locked by noon. The silent cut on credit is the first step. The second step is the restriction of cash withdrawals. They want to trap you in the digital ledger. If your credit is cut and you can't get cash, you are 100% dependent on their digital permission to survive. If the bank says no, you don't eat. That is the ultimate destination of this road. Total control. The end of financial sovereignty. Consider the timing of all this. This credit contraction is happening simultaneously with the renewal of millions of mortgages at significantly higher rates. In 2025 and 2026, roughly 60% of all outstanding mortgages in Canada are coming up for renewal. Homeowners are going to see their payments jump by 30, 40, or even 50%. This is what financial analysts are calling the payment shock. Under normal circumstances, if your mortgage payment went up by $1,000 a month, you might lean on your line of credit to smooth out the transition. You might use your credit card to buy groceries while you adjust your budget. But the banks know this. They know that you are about to be desperate for credit. And that is exactly why they are taking it away. They are preemptively cutting you off because they know you are about to need the money. It is like a hospital shutting down the emergency room right before a massive accident happens. It is cold, calculated, and absolutely ruthless. The impact on the rental market will be the next domino to fall. Many landlords are actually small investors who own 1 or 2 condos. They use lines of credit to pay for repairs, maintenance, or to cover the mortgage when a tenant moves out. When the banks freeze these lines of credit, the landlords run out of cash. They can't fix the broken boiler. They can't cover the gap between the rent and the mortgage. They are forced to sell. This floods the market with inventory, crashing prices further, which in turn causes the banks to cut credit limits even more aggressively. It is a feedback loop from hell, and in this chaos, the tenants suffer. Maintenance stops. Evictions rise as landlords get desperate to raise rents. The fabric of the housing market tears apart. We also need to talk about the data sharing aspect of this. The algorithm that decides to cut your credit isn't just looking at your bank account. Open banking protocols are becoming the norm. This allows financial institutions to share data about you across platforms. Your credit card issuer knows what you are doing in your checking account at a different bank. They know if you applied for a payday loan. They know if you missed a payment on your utility bill. The net is tightening. Your financial behavior is being aggregated into a single risk profile. If you slip up in one area of your life, the consequences ripple across every account you own. You could miss a cell phone payment and find your business line of credit frozen the next day. The interconnectivity of the financial system has turned into a trap. There is no privacy. There is no compartmentalization. You are exposed. So, how do you survive the freeze? The walls are closing in, but there are still cracks in the system. First, you must lower your utilization if you can. If you have cash savings earning 2% interest and credit card debt costing you 22%, pay off the debt immediately. Do not hoard cash in a savings account while holding debt. The bank will cut your limit to match your balance, so you might as well have a zero balance. Second, diversify your banking relationships. Do not have your mortgage, your checking account, and your credit card all with the same bank. If that bank decides you are a risk, they can freeze everything at once. It is called the right of offset. They can drain your checking account to pay your credit card without your permission. Split your finances across multiple institutions to minimize the damage if one decides to cut you off. Third, and this is the golden rule, cash is king. Keep cash outside of the banking system. I am not talking about millions of dollars. I am talking about enough to buy groceries and gas for a month if your cards stop working. When the digital system freezes, whether by algorithm or by a power outage, cash is the only thing that speaks. It is the only form of payment that does not require permission from a third party. Fourth, stop relying on the lifeline. You must mentally accept that your credit limit is zero, and do not plan your budget assuming you can float expenses on a credit card. Act as if the bank has already sent you the letter, because the letter isn't coming. The cut will just happen. You need to operate with a recession mindset today, even if you still have your job. We are entering a period of history where the rules of money are being rewritten. The social contract between the bank and the customer, the idea that if you are responsible, you will be rewarded with access to capital, is broken. The banks are preparing for a crash. They are putting on their life jackets and pushing you off the boat. The era of easy money is dead. The era of access denied has begun. You need to check your account. You need to check your limits. And you need to get your house in order because the financial winter isn't coming. It is already here. The silence you hear isn't peace. It is the sound of the system shutting down. Do not let yourself be caught off guard. Share this information with your family. Warn your friends, because the algorithm doesn't want you to know this, and I don't know how long we can keep saying these things out loud before the channel itself is deemed a risk. Stay safe, protect your capital, and keep your powder dry.